Is it possible that we are standing on the precipice of a new economic era, an era marked by the dance of inflation and recession fears, and punctuated by a surge in gold investment? This question is not just academic, but a stark reality we grapple with today. The Federal Reserve, under the stewardship of Jerome Powell, finds itself navigating these murky waters. The U.S. economy, on one hand, has seen inflation ease significantly, while on the other, the labor market remains robust. This scenario, as paradoxical as it may seem, is the current economic reality. Powell has acknowledged these positive developments, but has not shied away from addressing the elephant in the room, the persisting issue of high inflation. His comments, hinting at potential policy adjustments for economic stabilization, have sent ripples across the financial markets. Gold prices have soared to unseen levels and stock markets have rallied, painting a picture of a nuanced investor response to the Fed's potential policy trajectory. However, the broader economic narrative is not all sunshine and roses. A stark dichotomy exists between flourishing sectors and those barely keeping their heads above water. Rising costs have left many Americans struggling to afford basic necessities, casting a long shadow over the robust economic indicators. This scenario has prompted a reevaluation of the Federal Reserve's inflation targets and a growing sentiment that more accommodative policies may be required to stave off the looming threat of recession. Experts have chimed in on this conversation, suggesting that the Federal Reserve may lean towards lowering interest rates in response to recessionary pressures. The inverted yield curve and shifts in the money supply, both historically reliable predictors of economic downturns, have added fuel to these concerns. The conversation doesn't stop there. The banking sector, especially small banks, are feeling the heat amidst a deteriorating commercial real estate market. With significant debt maturing in the coming years and rising vacancies in commercial properties, fears of a potential banking crisis reminiscent of the 2008 financial crisis are palpable. Amidst these uncertainties, there's been a surge in interest in tangible assets like gold and silver, seen as safer havens in times of economic instability. The transition towards digital currencies and its implications for traditional forms of money have also been part of the dialogue. In conclusion, the Federal Reserve is tasked with maintaining a delicate balance in steering the economy through these uncertain times. The emphasis on tangible assets underscores a broader search for stability in an increasingly volatile economic landscape. It's a cautious optimism, one that's tempered by the lessons of past downturns. The question remains, how will the Federal Reserve navigate these challenges and opportunities in the days to come?